Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
This is Brian Boland, and I am the Aggressive Growth Stock Strategist here, and I am giving you my top stock pick for the week. And no surprise for me, longtime people that have followed me and my crazy actions here at Zacks know that I'm a big fan of Tesla, shareholder and all, and even owner of one of the cars. So it is my top stock pick for the week. Tesla, TSLA is the ticker. It's the Zacks rank number 3, and that gives it a hold right now. But the value scores are telling the value and growth scores are telling me it's exactly what I want to see. It has a strong growth score and a weak value score, and I would be really concerned about that if I was doing a aggressive growth stock pick for the week. But I'm doing a top stock growth pick or a top stock pick for the week. So let's take a look at some of the reasons why I like Tesla. Now, there's a big reason coming up, but I think longer term we got to look at these sorts of items. Look at the surprise history. Big time positive surprise, big time positive surprise, big time positive surprise. Look at those. Those are huge numbers. Sure, a couple small losses here last couple quarters. But boy, oh boy, if you look at the estimates straight up here, 26 to 46 cents. Here's, 50 cents, 49 cents, 50 cents. Here's the full year to $1 to almost $2 and 250 next year to 291. Things look positive for Tesla, even with the stock going bonkers here lately, and part of that crazy SoftBank beta gamma squeeze. But the valuation is stiff. We got 230 times forward numbers, 38 times book value, 15, 16 times price to sales, all big things. This number's a little misleading here, minus 5% over the top line there. But what we really like to see is this margins moving higher from a loss of 3.5% to 55 basis points to a positive 1.3 percent there on the net margin or on the operating margin, and that's important stuff. It's the same there for the net margin as well. So let's get rid of that, and we'll go to my next page here, which is the stock price, the graph here, and you can see it's just like this. It's just crazy. Who knew that Tesla to 500 would be a thing 2 times in the last year or so? So, there was the stock split. A lot of people thought that this move was, all about the stock split. Actually, it was, kind of that gamma squeeze that SoftBank was doing, forcing Goldman Sachs and Citadel and others to continuously cover and do that. But why is this the stock pick for the week? Because we've seen it, really move up like this. Why would you want to put new money in right here? And that's because tomorrow is Battery Day. Boy, what does that mean? Battery Day. I think the idea is that we're going to learn all about their batteries. How are their batteries going to work? Are there going to be major developments at Battery Day? Elon Musk has already tweeted out that there is going to be some pretty significant things disclosed on Battery Day. So we want to keep our eye on this one. I noticed the stock was up this morning in the pre-market trading, trading around 450, traded all the way down to 410 or maybe even below this morning. And if Terry Ruffalo, if he were here, virtually or not, he would say today is the 21st of September, and that was the time at which it was traded, $450 to a range of 410. But tomorrow is the day for Battery Day, and that is what you got to keep on your radar. And that's why I chose this stock for my top stock pick for the week. Now, let me throw this over to my good friend and colleague, Ben Rains.
Thanks, Brian. I'm going to jump into JD.com, which is one of China's biggest internet companies by revenue. And the e-commerce powerhouse sells everything from smartphones, clothing, and food, and even industrial products. The firm also operates travel services and runs a logistic and fulfillment segment. The company also offers a variety of professional services, including consumer targeting, marketing, analytics, and financing. And JD's budding healthcare division features pharmaceutical and healthcare products and services. So, like Amazon, JD aims to touch every aspect of life, but unlike in North America, JD is going for China. So investors should also remember that the growing Chinese middle class could continue to grow for years and years to come, which could help JD and other big retailers. So McKinsey estimates that China's middle class could hit 550 million by the year 2022. So just in a couple years, which is far larger than the entire U.S. population of about 330 million at the moment. So with this in mind, JD posted strong Q2 results back in mid-August, with its sales up around 30%. Its annual active customer accounts also jumped around 30% to 417 million in the quarter, with its mobile daily active users up about 40% as well. So with this in mind, we're going to take a look ahead quickly, and our Zacks estimates are calling for JD's adjusted fiscal 2020 earnings per share jump about 45% on 25% stronger sales, which is really great amid all of this coronavirus uncertainty. And then if we look further ahead, its bottom line is expected to climb another 54% on another 21% stronger sales in FY21. So some big top and bottom line growth is expected this year and next. And on the earnings revision front, it's seen some positive activity recently, which helps it earn a Zacks rank #1 strong buy at the moment, alongside its A grade for growth in our style score system. It's also part of a highly ranked industry at the moment, and its shares are up 110% in 2020 to crush the broader e-commerce market's 50% climb as people continue to shop from home amid this economic environment, and easily outpacing Amazon's 56% climb in 2020. And if we look back over the last 2 years, JD looks even more impressive. It's up about 200% against Amazon's 50% climb and Alibaba's 60% climb. We should also note that the stock trades at a significant discount in terms of forward sales to its peer group, as well as Amazon and Alibaba. And the stock is trading at about $74 per share on Monday morning, which marks about a 10% discount compared to its recent highs. So it's suffered alongside some of these other tech names that have taken a hit in the last couple weeks. And that $74 looks a lot cheaper than, say, Amazon's nearly $3,000 per share. So in the end, investors might want to take a chance on this Chinese tech-focused retailer that's got Amazon-style expansion on its mind, but it does come at a far cheaper actual price point and a more enticing valuation. So that does it for our top stock picks on Monday. I'm Ben Rains.